Hey everyone, welcome back to Corporate Decoder. Today we're diving into Teradata's latest filing, and I promise it's more exciting than watching data warehouses being built brick by brick. But seriously, we're going to unpack what's happening with this data analytics company, what their numbers are telling us, and what it all means for their future. Before we get started, if you like getting straight to the point when it comes to corporate reports, make sure to subscribe. We also have a Discord community linked in the description below for more discussions. Let's jump right into it. Teradata just released its first quarter results for 2025. We're going to look at how they performed and what they expect for the rest of the year. They've also posted some extra materials on their investor relations website, but don't worry, we're focusing on what's important here and in the filing. The company issued a press release covering the earnings from the last quarter and expectations for the next one, as well as the entire year. This is a quick way for investors to get up to speed on essential highlights from the filing without reading all of it. This is going to be our guide. Teradata is listed on the New York Stock Exchange under the ticker symbol TDC. Keep an eye on that if you're interested in their stock. We see here that they are providing exhibits in this report. One of them is the earnings press release that we just mentioned. Alright, let's cut to the chase and talk numbers. Total revenue came in at $448 million. That's the money they made from selling their products and services. Now here's a key metric. Total cloud annual recurring revenue, or AR, reached $686 million. This is super important because it shows how much money they're making from their cloud services on a recurring basis each year. Think of it like a subscription that keeps the money flowing in. Within that, public cloud AR hit $502 million. Public cloud means they're offering their services on platforms like Amazon Web Services or Microsoft Azure. This is important because public cloud is often seen as the future of data analytics. Recurring revenue overall, which includes both cloud and other recurring services, landed at $389 million. This shows how much of their revenue is predictable and stable. Gross profit reached $259 million. This is what's left over after subtracting the cost of providing their services from the revenue. It tells us how efficient they are at delivering those services. Here is a significant number. Net loss was $17 million, so they didn't make a profit. They actually lost money this quarter. We need to see why. But wait, there's also something called adjusted EBITDA, which was $99 million. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Adjusted EBITDA just means they've taken out some unusual or one-time expenses to give a clearer picture of their underlying profitability. In simple terms, this number is often higher than net income because it ignores some costs that can make a company look less profitable than it is. Diluted loss per share was negative 0.116 cents. This is just another way to show how much money they lost in the quarter. Cash from operations was $152 million. This shows how much cash the company generated from its regular business activities. It's a good sign if this number is positive, as it shows they're bringing in cash. Free cash flow, which is cash from operations minus capital expenditures, was $140 million. This is the cash they have available to reinvest in the business, pay down debt, or return to shareholders. What's next? They're expecting cloud ARR to be between $715 million and $725 million for the second quarter. They're also forecasting recurring revenue of $397 million, $7 million to $397 million, $30.97. For the full year, they're aiming for cloud ARR between $815 million and $835 million. Total revenue is expected to be between $1.795 billion and $1.825 billion. Now, the filing includes a safe harbor statement. This is basically a disclaimer saying that some of the statements they're making about the future might not actually happen. It's there to protect the company from lawsuits if things don't go as planned. Looking at these results, Teradata is in an interesting spot. Their cloud business is growing, which is good because that's where the industry is headed. The ARR number is a strong signal that they're getting more subscription revenue. However, they're still reporting a net loss. That suggests they have more work to do controlling costs and turning that revenue into profit. The adjusted EBITDA gives a slightly more positive spin, but at the end of the day, investors prefer to see a net profit. One thing to watch is how well they can keep growing that cloud R. If they can hit their targets for the year, that would be a big win. On the other hand, if they start to miss those targets, it could signal trouble. Alright, that's our breakdown of Teradata's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.